All right, good afternoon, everyone, and welcome to our 2021 Mid-Year Outlook for the economy and the markets. Now, most of you on the call today are existing clients. However, for those of you who are joining us for the first time, welcome. My name is Jim Kropog. I am a certified financial planner with Kropog Financial Group. We are a family-owned financial planning firm with offices in Mandeville and in New Orleans. And for the past 42 years, we've been helping our clients to organize their financial lives, to pursue their financial goals, and to preserve and grow their hard-earned assets. And we do this by utilizing the comprehensive financial planning process. So welcome, everybody. Before we get started, I have a few housekeeping notes. Your microphone is muted. So during the course of our webinar today, if you have any questions, simply email those questions to Calvin, and we will follow up with our responses within the next 24 to 48 hours. If you are experiencing any technical issues, please call our office at the number you see on the screen, and Calvin will be happy to help you. So you might want to write this information down or take a picture of this slide in case you need it. Hopefully there won't be any technical issues, but certainly any questions, forward those questions to the email you see on the screen to Calvin. All right. So a lot has happened in the first part of this year, I should say, in the economy and the markets. So let's take a look at the mid-year outlook for the rest of 2021. So the U.S. economy has picked up speed and it's powered forward faster than anyone has expected or had expected for the first half of 2021. Overall, the economic picture remains sound, which may support strong company profits and potential stock market gains going forward. However, the fast pace of the reopening of our economy has also created new issues. Supply chains are stressed. Some labor shortages have emerged. Inflation is heating up, at least temporarily. And of course, now we're seeing a significant uptick in the number of new cases of the COVID variant. So, looking at this new environment in our mid-year outlook, we're going to cover the outlook for the economy, government policy, stocks, and bonds. So the economy, the U.S. economy has surprised nearly everyone to the upside as it speeds along thanks to vaccinations, reopening, and record stimulus from the Federal Reserve and from Congress. All of this has combined to produce what could be one of the best years for economic growth ever. The rate of growth of the U.S. economy may have peaked in the second quarter of this year, but there's still plenty of momentum left to extend this above average growth into 2022. Now, we're getting a lot of questions about inflation. So before I proceed, I wanted to take a minute to address the inflation issue. Much of the increase that we've seen in inflation is driven by supply and demand factors that are likely to subside in the coming months. For instance, the semiconductor chip shortage is reducing the supply of new cars, just as the economy is reopening and the surge in consumer demand heats up. Increased prices for new and used cars, along with the increase in prices for lodging and transportation, contributed to a vast majority of the increase in inflation. Additionally, temporary labor shortages means that businesses have to pay more to attract workers. This drives up their costs, which are passed along to consumers. This should subside as the unemployment benefits drop off and more people are forced to go back to work. In fact, the Federal Reserve recently reiterated its view that inflation has risen because of these supply chain bottlenecks, hiring difficulties, and other largely transitory factors related to the economy's rebound from the pandemic. And most analysts in projections released just last month believe that inflation will decline to around 2 to 3% over the next 2 years. However, if we see a sustained large increase in inflation, it could compel the Federal Reserve to raise interest rates earlier than planned in order to achieve its 2% average inflation goal. And this could cause market volatility. As always, we will be monitoring the inflation numbers very closely. So one of the best measures of how the economy is doing is what's called gross domestic product, or GDP. That's a term that we hear a lot. Now, GDP is simply defined as the total value of goods produced and services provided in a country during 1 year. For the US, as a result of the strides made toward full reopening, our economy, rapid vaccine distributions, massive stimulus efforts, and support from the Federal Reserve, we maintain our 2021 forecast for GDP growth to be about 6.25% to 6.75%, as you see here. Now, last year's 3.5% drop in GDP, because we had the recession, of course, was the worst year since the Great Depression. And this, although we haven't forgotten this, it's kind of been left in the dust because of the growth that we've seen. As you can see here in this chart, as I'm highlighting, in the beginning of the year, we forecast that gross domestic product growth would be about 4%. Now the estimate is for closer to 6.5%. So GDP has just powered forward. Now globally, Europe and Japan, the second row here, has been slower to move past the pandemic. Okay, you can see that the projected GDP for this year was 3.6, and currently it's just a little bit higher than that. But their growth could explode once they move further past the pandemic. And meanwhile, emerging markets continue to be a source of solid growth, with several Asian emerging markets being among the first to recover from the pandemic. So you can see their projected GDP growth. So as this chart indicates, global economic growth for 2021 is projected to be strong, with the US economy leading the way. This new economic expansion, which began in April of 2020, could last years. In fact, as this chart indicates, since World War II, we've had 13 economic expansions, lasting an average of 5 years, this orange line here, with the 4 most recent cycles going even longer than that. In fact, the most recent expansion, which began in July of 2009, was the longest ever at almost 11 years, and might have gone even longer if COVID-19 hadn't struck. However, this current cycle right here that we're in the summer of 2021 may not continue as long as this last one, considering the recession in 2020 wasn't your average recession. Because the recession last year was the shortest ever and the economy was supported by historic stimulus, some imbalances weren't worked off like we tend to see in a normal recession. Also, corporate debt levels remain high, supported by low interest rates. and stock valuations never really reset. The good news is that this new cycle of growth that we're in now has enough going for it to at least be average, which means that we could still have another 4 years of economic growth. In fact, many economists are maintaining forecasts for solid economic growth due to expectations of steady hiring and continued spending driven by accumulated savings and Americans' desire to travel and socialize more. The new COVID variant, while spreading quickly across the world, is more at this point a public health issue. It hasn't yet triggered the widespread closures and layoffs and restrictions on business activity that occurred in the spring of 2020. What we may see instead are targeted restrictions based upon COVID spikes in certain geographic areas, predominantly areas with low vaccination rates. However, much uncertainty still remains. The spread of the COVID variant is a risk for the economy, but that risk may be more than offset by what are still very strong economic fundamentals. We'll be monitoring this situation very closely. So what does all of this mean for the US dollar? We're getting a lot of questions about that as well. We think there are many more years of weakness could be in the cards for the US dollar. We view that the twin deficits of the US economy, which is the combination of the budget deficit and the trade deficit, as long-term structural drivers that may continue to put a downward pressure on the dollar over time. Now remember, there are pros and cons to a weaker dollar. On the downside, a weak dollar means that foreign products are more expensive to US companies. And for US companies with overseas operations, production costs rise when the dollar falls. However, a weak dollar can be a good thing for US companies who want to sell their goods overseas because US products become less expensive for foreign buyers. Also, US capital markets become more attractive to foreign investors if the dollar weakens. And tourism may benefit from a weaker dollar because the United States becomes more affordable for foreigners. It's important to remember that the US has never defaulted on its debt. That relative safety has always made the dollar the strongest currency in the world. So let's move on to government policy. We feel government policy may take a back seat. During much of 2020 and early 2021, the markets have been focused on fiscal policy due to massive government efforts to help the economy speed past the impact of COVID-19 restrictions. Some of the stimulus efforts like printing money, lowering interest rates, forgivable loans to businesses, increased unemployment benefits, money deposited in people's bank accounts. These things happened a lot in 2020 and early 2021. And policy still matters now, but it will matter less to markets over the rest of 2021. While the markets may anticipate an increase in government spending if Congress passes some version of the Biden administration's Build Back Better initiative, that spending will likely be spread out over almost a decade. The biggest risk to the markets may be around taxes, with businesses and wealthy households both facing the prospect of a higher tax burden to pay for the plan and to help manage the deficit. President Biden has proposed increasing the corporate tax rate from 21% to 28%. But that should be viewed as a starting point for bargaining, right? And we believe that the more likely outcome is that we see, at least, is for the rate to end up closer to 25%. Now, since the stock market is fundamentally driven by corporate earnings, an increase in corporate taxes will likely be a headwind for the stock market. However, it's important to look at the historical data regarding corporate tax rate increases and the effects on the stock market, right? It's always important to look at the data. So as we look at this chart, you can see that we've had 8 corporate tax rate increases since the 1940s. You can see what the old rate was and what the new rate went to, the name of the legislation that enacted those corporate tax increases. But then when you look at how have those corporate tax increases affected stocks as it responds or correlates to the S&P 500. You know, what the stock market did 3 months later, 6 months later, and a year later. So if you look out 12 months after all of these corporate tax rate increases, you can see that in 5 of those 8 periods, the market was positive. 62.5% of the time, the market was positive. Okay, now the average rate of return in the next 12 months was more moderate at 4.2%. So as you can see, historically, markets have absorbed higher corporate tax rates, although with below average returns. Now, this new proposed corporate tax increase has been anticipated for quite some time and should not be much of a surprise to the markets. Also, excluding the 2017 reduction in corporate tax rates under President Trump, a 25% corporate tax rate, if that's what we end up with, will still be the lowest tax rate in about 70 years. Now, that being said, if we do see higher corporate taxes, that could take away some of the momentum that we've seen in corporate earnings so far in 2021. And it could contribute to a choppier market. So we'll have to see how that plays out over time. Now, the Biden administration has also proposed increasing the top tax rate on ordinary income from 37% to 39.6%, and capital gains taxes from the current 23.8% to a maximum of 43% for those who earn more than $1 million a year. Now, 2 important things to note about that. Number one, only 0.32% of the population, 0.32, makes more than $1 million a year. So the truth is, this won't impact the other 99.68% of the population. Also, often what is proposed did not become law. Negotiations take place, which usually results in the proposals being watered down. Now, looking at the historical data, again, we have to let the data drive our decisions. Capital gains taxes did increase in 1986 and in 2013. But the economy during those periods of time was on firm footing compared with the 1970s hikes, which saw an economy at that time was marred by higher inflation and sluggish growth. So not surprisingly, the 2 most recent hikes saw solid stock market gains over the next 12 months, while the 1970s hike did not. It's as simple as how the economy is doing. Policy matters, but broader economic trends matter more. So let's talk about stocks. Now, we expect strong economic recovery to continue to drive earnings, which should support further gains for stocks. However, after one of the strongest starts to the bull market in history, stock prices already reflect a lot of that good news. So, as inflationary pressures build and as interest rates potentially rise further, the pace of the stock market gains may be slower. So here are our market forecasts for the 2021, including Treasury yields, earnings, and stocks. So we see the U.S. Treasury yield ending 2021 between 1.75 and 2%. The current 10-year Treasury yield is about 1.3. More on yields in a bit when we get to the bond section. Our forecast for 2021 S&P 500 earnings per share is $195, which is above the consensus estimates, and that's a 36% increase from 2020. And finally, we see additional gains for stocks in the second half, but they're likely to come at a slower pace and with more bumps along the way. Our forecast is for the year-end fair value of 4,400 to 4,450 for the S&P 500. Currently, it's right around 4,400. Okay, so we should see some growth there, but it's going to be at a slower pace and a bit choppier. So we're currently in the second year of this bull market, which began in April of 2020. And although this market cycle is like no other that we've experienced in modern history, studying the second year of historical bull markets can be instructive. So we're in the second year of this bull market. Now, looking back at all the bull markets since 1950, as you can see on this slide, the average S&P gain, right, during that time has been about 13%. This blue right here, the blue represents the second year gains of an average bull market, and we're currently in the second year. The average gain has been about 13%. You can see the first year of bull markets, of course, is much higher, but we're in the second year. Okay, so as this bull market gets further into the second year, we would expect some volatility to pick up. Now, also shown on this chart, the average pullback, right? The markets pull back sometimes. The average pullback for the index during the second year of bull markets has been about 10%. Remember, pullbacks are normal. However, given the boost from the reopening and government stimulus still working its way through the economy, any pullbacks may be short-lived and corrections less severe. Now, it's important to note that inflation and possible tax increases are the potential causes of corrections. So remember, earnings drive stock prices, and the stock market is forward-looking. So if current earnings are strong and future earnings expectations are high, then the stock market will generally move higher. Now, coming off of a stunning first quarter earnings season with one of the biggest upside surprises ever recorded, corporate America is currently firing on all cylinders. Not only are earnings expected to ramp up significantly over the remainder of 2021 as the economic rebound continues, but momentum is building as estimates have significantly increased this year. So our forecast for the S&P 500 earnings per share in 2021 is $195. And this is a 36% increase over 2020. We then expect corporate America to build on its strong earnings performance in 2022 and possibly deliver a $205 earnings per share for the S&P 500. So we've had an amazing run in stocks, and we expect this general trend to continue. But here are some things to consider. Stocks move up and down, not in a straight line. They never have, and they never will. The S&P 500 index has not had a 5% pullback since last October, right before the election. One of the longest stretches ever. Also, the S&P 500 has averaged about 3 separate 5% pullbacks since 1950. So remember, think about that. Every year since 1950, the markets have averaged 3 5% pullbacks per year. We haven't seen that since last October. Also, the index has not had a 10% correction since March of 2020. And historically, the market has averaged 10% correction per year since 1950. So, as I mentioned previously, expect some pullbacks in the 5 to 8% range and possibly a 10% correction as we continue to move higher. Do not let these pullbacks and corrections frighten you out of your long-term plan. Very important. All right, let's talk about bonds. Now, after one of the worst starts to a year for bonds, returns for bonds might not get much better from here. We expect long-term interest rates to move higher over time, which would put a downward pressure on bond prices. However, we're not giving up on short to intermediate term high-quality bonds in our clients' portfolios, as bonds historically have been the best diversifier during times when stocks are pulling back or correcting. And remember, we can expect pullbacks and corrections ahead of us. Most of our clients prefer not to swing for the fences with their investments. They would rather smooth out the ride. Now, they won't capture all of the highs in the stock market, but they also won't capture all of the lows. So that means having a well-diversified portfolio of stocks, bonds, cash, and real estate. A portfolio in line with their financial plan and their risk tolerance. So what does this mean for bond returns? Simply put, rising interest rates can negatively affect the return of bonds that one currently holds in their portfolios. As seen on this slide, as interest rates rise, over here to the right, if they go up 10%, 20%, 30%, and what does that mean? A 10% increase in interest rates means if it's currently at 1, it moves to 1.1. A 20% would mean it moves from 1 to 1.2. Okay? So because we believe interest rates have the potential to move higher from current levels, bond returns may end the year with low to possibly negative returns. And that would be the first time since 2013. Negative total returns don't happen a lot for bonds. It could happen this year. We don't know. Now, as interest rates move higher, the returns for bonds bought in the future get better. So while this year may be disappointing, future returns for bonds are likely to be better, although we don't have any guarantee of that. So how does one invest in this environment? We suggest investors consider reducing the interest rate sensitivity in their bond portfolios. This simply means that one should own short to intermediate term bonds, which are less sensitive to rising rates. Remember, stocks can be volatile. Pullbacks and corrections in stocks happen all the time. So for most clients, owning high quality, short to intermediate term bonds as part of a well diversified portfolio still makes sense. They can potentially offset the volatility of your portfolio and help smooth out the ups and downs. This may help you to stay the course as you work toward your long-term investment goals. Now, as I mentioned earlier, if you have any questions, you can submit those questions. We'll respond within the next 24 to 48 hours. However, we did have a couple of questions that were sent in prior to today's webinar, and I wanted to take a few minutes to address those questions. Question number one, what are your thoughts about the real estate sector? So many of our clients own real estate as part of their diversified portfolio. Now, prior to COVID, the COVID-19 pandemic, we felt good about most real estate sectors. However, like many areas of the economy, the pandemic has either changed or accelerated real estate fundamentals. For instance, the retail real estate space was already being negatively affected by the expansion of e-commerce. But because of the shutdown of the economy due to COVID, online shopping exploded. More people are now buying products online, and we see that trend continuing. The office real estate space was another area negatively affected by COVID as more people worked from home. It's going to take some time now for businesses to figure out what works best for them. We may very well end up with what's called a hybrid work environment where employees work from home at least a few days per week. As such, the demand for office space will go through a period of adjustment. On the other hand, we see an increasing demand for industrial and residential real estate. More warehouses are needed to store products for fast delivery, and apartments are in a great demand now as the increase in home prices have made them unaffordable for a lot of people. So for many of our clients, owning real estate as part of a well-diversified portfolio makes sense. So let's talk about Apple. The other question was, should I keep my Apple stock? Our clients know that we're not stockbrokers, right? We're financial planners. We focus on helping our clients to accomplish their financial goals and to grow and protect their assets utilizing the financial planning process. Now, that being said, for most of our clients, Apple is one of their largest stock holdings within their ETF positions. Apple is one of the largest companies in the world. They have a competitive advantage in their space. They continue to innovate and diversify their business model, and they have a ton of cash. We don't see that ending anytime soon. In fact, Apple just posted their biggest quarterly profit in its 45-year history. Apple earned almost $22 billion, that's with a B, $22 billion in profit, not revenue, profit, for the 3-month period just ending in June, while their revenue rose 36% from a year earlier to $81 billion in a 3-month period of time, and that beat expectations. Now, of course, like any company, their revenue and their profits will slow down from time to time, and their stock value will move up and down. Also, we've got to be mindful of potential future government regulation of large technology companies. However, at this point, we don't see any reason to make any preemptive adjustments based upon regulation that may or may not happen. So I hope that addressed those two questions. Those are great questions, by the way, and I hope I did a good job of answering those two questions. So, what could the rest of 2021 hold? Well, there are always going to be surprises when it comes to investing. And in that respect, 2021 is no different than any other year. Still, our big calls that we made at the beginning of this year, that stocks would significantly outperform bonds and that the economy would likely see one of its best years ever, are still alive and well so far. The economy continues to improve and the earnings backdrop is spectacular. However, these are also the times when financial planning is most effective. Early in the economic cycle, with the next recession possibly years away, a strong start to this bull market, which is in full gear, and a relatively calm market environment. However, a regular review of your financial plan and your investment portfolio is critical as you advance toward the goal of accomplishing your financial objectives. Right now, in fact, is the ideal time to consult your financial advisor regarding your financial goals, the most effective way to reach them, and how to be prepared for potential market volatility down the road. So that concludes our mid-year outlook for 2021. I want to thank all of you for taking time out to join us on this webinar today. If you have any follow-up questions or would like to speak with us prior to your next review meeting, just send us an email or call the office. Someone from our team will be happy to help you. Now, be sure to join us again in December when we present our market outlook for 2022. As always, thank you for your business. By choosing to partner with us, you've opened up your financial lives to us, and that's something we don't take lightly. And we'll continue to work hard for you as you move towards achieving your financial objectives. Thanks, everybody, and have a great day.